The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Macroeconomics and geopolitics combining to widen the divergence in U.S. financial markets. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Let's talk about this rotation. The S&P 500 down by about 0.1%, but then take a look at what's happening in the NASDAQ 100. Your big tech stocks down about 0.8%. NVIDIA, Apple helping to lead that slump. And surprise, the Russell 2000 up by about 1% right now. It is the little guys leading the market. A little bit of a sell-off underway in the bond market all the while. The 10-year Treasury yield higher by about 3 basis points, Romaine.
Yeah, absolutely. Here, and we talk about the divergence right now between small and large caps. The Russell 2000 beating the NASDAQ 100 by 4 percentage points over the first 5 sessions of 2026, the second best outperformance to start a year ever. Investors betting earnings growth for small caps will outpace large caps, a sentiment Bloomberg Intelligence called out a month and a half ago, with estimates for 45% profit growth for the Russell versus 14% for the S&P, though there is one big asterisk, and that is that outperformance is dependent on the state of the economy. As for the state of the economy, it still remains a big question mark here. On one hand, U.S. companies are announcing fewer layoffs. Labor productivity is at its strongest in 2 years, and that's actually been tamping down some of the inflationary pressures from wages. But Fed Governor Stephen Miron, he thinks the labor market is far too weak and Fed policy far too restrictive, making the case today for 150 basis points of rate cuts this year to get things back to neutral.
We're still materially above neutral in my mind, and there's not really a reason to be materially above neutral if the labor market is on a weakening path and inflation is an underlying inflation's already running close to our target and on trajectory to hit the target. There's just not a real reason to be so restrictive, and we're running unnecessary risks on the labor market by being so restrictive.
Now, in Myron's defense, the New York Fed's latest consumer survey did show perceptions of job availability is at the worst in at least 12 years, and perceptions do matter. Though that same report showed inflation expectations rising, which of course works against Myron's argument. And then there's that big asterisk around destabilizing geopolitics, which this week pushed institutional investors surveyed by Goldman to their most bearish view on oil prices in a decade. And Katie, I should add, that BI report from a couple of months ago, they also added another asterisk, and that was on tariffs.
On tariffs, I was going to say, let me add another one to the list because, of course, we're counting down to that potential decision coming from the Supreme Court tomorrow on whether or not President Trump has the authority under IEEPA to actually impose some of the tariffs that he introduced in April. So let's ask the betting markets what they see. And you take a look at Kalshi, you take a look at Polymarket odds right now, and overwhelmingly betting odds on Supreme Court rulings in Trump's favor. It seems like the betting markets are taking the other side of that because on Kalshi, it's just a 28% chance that Trump gets his way. Polymarket a little bit lower, 25%, Romaine. So again, counting down to about 10 a.m. tomorrow. That's when these decisions typically come out. And potentially the speculation is that we're going to get that tariff decision at that time tomorrow.
All right, well, joining us right now to kick us off to the close is Jill Carey Hall. She's the U.S. equity strategist and head of U.S. small and mid-cap strategy at Bank of America. And of course, she is, I think, relatively bullish on the small and mid-cap space. And Jill, I am curious, assuming that what I just said is true, I don't want to put words in your mouth, how does tariffs, the economy, and some of these geopolitical issues, if at all, affect that forecast?
Right. Well, I think, overall, we're expecting healthy economic growth for this year, close to 2.5% U.S. GDP. And I think if we're in an environment where economic growth is holding up and we get some further rate cuts, that's a good environment for small caps. I think what really is going to matter for small caps this year is that profits recovery that you were talking about, because that's been so elusive for small caps. Usually small caps, when they're in an earnings recession, their profits get hit harder and they bounce back faster. But that faster bounce back didn't happen this time. The can kept getting kicked down the road. And that's one reason, small caps struggled, for much of last year, in addition to uncertainty around tariffs. And now we are seeing better revisions, better guidance from companies that give more confidence in that earnings recovery. And if we do see, lower tariff rates, if there is a reversal in IEEPA tariffs that would make tariff rates lower, this would be a relative positive negative for smaller companies because they have much thinner margins. So they are more hurt by those higher input costs.
What if the IEEPA isn't overturned? Is the status quo enough for these companies, though, to still, and I'm talking about small and mid-cap companies, to outperform? Meaning, the tariffs may not go down, but at least you've had, however many months, 6, 7, 8 months now to know what those tariffs are.
Right. I mean, we're obviously in a better place in terms of the effective tariff rate relative to earlier last year, and there's less uncertainty, and uncertainty and volatility are not good for small caps. So status quo is better than uncertainty. There's still some risk that companies did build up inventory into tariffs, so there is some risk that we do see more of the impacts start to show up, this earnings season, as companies moved through that inventory that they had built up prior to tariffs. So I think this earnings season will be important to get a better sense on some of the implications there. But corporates have been very resilient, and they've been able to maintain, pretty healthy margins even amidst some of these pressures. So I think, if we get more confidence from corporates, similar to the guidance that we saw this past earnings season, which was very positive, that'll continue to give investors confidence in this long-awaited small cap profits recovery for stocks that are, often trading at much cheaper valuations than their larger counterparts.
Well, Jill, let's talk about that outperformance that Romaine mentioned a little bit. I want to read this stat again because I think it is stark. The Russell 2000 has outperformed the NASDAQ 100 by 4 percentage points to start 2026. That is the second best outperformance to start a year on record. And let's talk about how positioning factors in, because when it comes to some of your large caps, the narrative is that this is a fully invested market. But when you take a look at some of these smaller tiered companies, how does it actually stack up?
Right. I mean, when we look at fund manager positioning for investors who can invest across the cap spectrum, small, mid, and large, investors have been very underweight small caps, significantly underweight even relative to history, where they've really shrunk these holdings in small caps over the past, several years and even decade. And that's come in tandem with small caps underperforming for the last decade. But, often these cycles run about, 6 years to 8 years. So this decade of underperformance, or now slightly more, has been historically long. So for investors with long time horizons, it would suggest that small caps could lead over the next decade. And certainly some factors could support that, reshoring of U.S. manufacturing, a CapEx cycle in the U.S. These are things that benefit domestic mid caps. So we're positive on small caps, on a cyclical basis, but do see potential for longer outperformance as well.
And Jill, I'm taking a look at your notes. You write that you prefer small caps to mid caps, you prefer mid caps to mega caps, but you're avoiding micro caps here. Tell us why.
Yeah, so, last year we saw this kind of interesting barbell of what worked, which was mega caps and micro caps were the best performers in 2025. And, part of that was we saw, elevated retail activity in some of these areas. We saw low quality stocks outperform. But micro caps really got to be very stretched. They're the most expensive segment of small caps. On price to sales, they've been trading about 80% above their long-term average. So even though a lot of the pockets within the Russell 2000 actually aren't that expensive, micro caps have gotten extremely stretched. And the Russell 2000 is actually so far beating the micro cap index a little bit this year. So we do expect a bit of a give back there. We wouldn't expect micro caps to continue to see such strong outperformance that they've seen. They are quite a bit more stretched than the rest of the small cap market.
Jill, always a pleasure, always smart. Jill Carey Hall, U.S. equity strategist and head of U.S. small and mid-cap strategy at Bank of America Merrill Lynch, kicking us off to the close here on this Thursday afternoon. When we come back, we pivot from U.S. small caps to international markets. Runa, CEO over at Development Partners International, making her case here why there might be better market return opportunities outside the U.S., specifically, Katie, in Africa.
Plus, Hamilton Lane's Elizabeth Bell joins us to talk the potential shift in the investment landscape at home. How President Trump's single-family home proposal will impact the large investors targeted. Now it's your turn, Roman.
Now it's my turn because I'm so excited to talk about a blockbuster box office year for Imax. We're going to catch up with the CEO, Rich Gelfond, a little bit later in the program and get his outlook for 2026. All that and more coming up in a bit. This is The Close on Bloomberg.
Well, data security company Cyera tripling its valuation to $9 billion in its latest funding round. The AI native platform raising $400 million in a Series F round led by Blackstone managed funds with the participation of big shot inside investors, including Lightspeed Venture Partners and Sequoia Capital. Joining us live in studio is Cyera founder and CEO Yotam Segev. Yotam, great to see you in person.
Great to be here. Thank you for having me.
So let's start with this $400 million, this raise that you've completed. What do you plan to use the money for?
Product, and more product. AI is generating new security problems that just didn't exist before, and the need to build incredible software in order to enable the enterprises that run our lives to adopt this AI technology and do it securely is greater than ever. And we're investing in our product, investing in our engineering, and making sure that we're going to deliver the best platform in the market for our customers.
So you think about cyber threats. I mean, this has been one of the biggest risks that CEOs have named that they're thinking about for years now. I have to imagine that AI and the speed at which AI is developing, of course, complicates that picture. So when you talk about these products that, you know, you're going to be putting this money to work in, I mean, how much of it is anticipating where these risks are going to pop up?
Yeah, I think that, you know, AI in the way that it operates is really changing the game for cybersecurity. And every enterprise is thinking about how to adopt AI, but they're also thinking about all the risks that are arising from it. This is a new world we live in, and most of us barely understand it. That's the truth. We're all in anticipation of finding out how this would look, what the agents are going to be like, what are they going to change in our lives and the way we operate our businesses. But the unknown is much greater than the known. So I think that laying the right foundation, being able to understand what the fundamentals of enabling this transformation for the enterprise are and doubling down on them today, that is the most important thing for enterprises to do.
I am curious, so when we talk about the benefits of AI to corporations, we talk about that a lot on this program. Makes things more efficient. In theory, you would need fewer people, and you can potentially do more. However, if you're a criminal, I would also assume you could also use a lot of these same AI tools to make your operation, your criminal operation, more efficient. So how do you sort of keep pace with that, knowing that the technology that you're trying to build out to protect those companies, the criminals are also using similar technology to exploit those companies?
Absolutely. I think AI is changing the threat landscape very quickly. Obviously, the criminals, the hackers, are not subject to regulation, nothing slowing them down from adopting the AI. Right? They don't have to be careful, and we very much want our leading enterprises to be careful. So I think that the challenge there and the frictions there is meaningful. For us, our job is to help the enterprises be able to say yes to AI and to say yes now.
What exactly, explain though how exactly your platform helps protect them. Is this just basically your proverbial gate, if you will, or is it more integrated into their operations?
Yeah, absolutely. So if you think about AI, AI runs on two things. It runs on chips, and you talk about those quite a bit with NVIDIA and all of these amazing companies, and it runs on data. And the first wave of AI we've seen gives us answers based on the internet, right? The data that's out there. The next wave, the wave that we're in now, is giving us answers and is acting on the company's proprietary data. And this is a new way of processing that information. It's more efficient, it's more promising, it has incredible value to offer, but the existing security controls are just unable to protect the data within these systems as they're being leveraged by AI. Cyera is building the solutions to enable our customers to give the most meaningful data to the AI engines, but stay in control of it, keep it protected, and make sure that they're getting value and not downside.
Well, I'd love to talk a little bit about your future plans for Cyera, because this is your Series F round, so we're getting further down the alphabet. Your valuation, again, tripling to $9 billion. That's certainly bigger than a lot of the small caps we were just talking about. How are you thinking about the public markets? Could an IPO be in your future?
We're thinking about building an amazing company, and I think that if you have a great business, customers that love you and value what you provide for them, there's many options of how to realize that value. Obviously, with the public markets being as they are today, it looks very promising, but who knows? When the time is right, we'll consider our options. We're definitely making sure that we have all the right doors open.
All right, Yotam, great to have you here. Yotam Segev there, he is the CEO and founder of Cyera, which just had a new funding round led by Blackstone. The value is a cybersecurity company of roughly about $9 billion. When we come back, the countdown to bank earnings. Stick with us. This is Bloomberg. All right, time now for our top calls. These are the big movers on the back of analyst recommendations. We start off with Nike. Needham downgrading to hold. The analyst saying Nike's turnaround taking a bit longer than expected, and he criticizes the brand's aggressive sell-in to the North American wholesale market and raises worries about intense challenges going on in China. Nevertheless, investors unfazed on the day. The shares up 3.5%. Up next, Intuit. Wells Fargo downgrading to equal weight. The price target getting cut to 700 from 840. Tougher year-over-year comparisons, presenting a more challenging setup ahead for the tax software company. That's according to the analysts, though those shares on a 4-day run. And finally, JP Morgan. Wolf downgrading JP Morgan along with Bank of America to peer perform. This is ahead of next week's bank earnings season. The analyst says the sector's massive rally in 2025 means investors should take some chips off the table. Those shares, though, they're higher on the day, at least for JP Morgan, and those are some of our top calls. We do want to stick here with the banking sector as we are expecting the kickoff of earnings season next week with JP Morgan, BNY, and quite a few others. All big names that we have to follow, and well, let's get some insight as to what to expect out of Betsy Graseck, Global Head of Banks and Diversified Finance Research over at Morgan Stanley. All right, Betsy, I do want to kind of unpack this from two separate angles. I mean, there is the fundamental story of what these companies will report, but there's also a valuation concern given the big run-up that we saw in the prices, at least of some of these companies, over the last few months. What takes priority for you?
Well, Romain, thanks very much for the question. And nice to be here and see you in 2026. Yeah. As we lean into earnings on Tuesday, what we're looking for is earnings to come pretty much in line with expectations. I'm a little bit above most of my names, and I'm above 3% versus consensus on both JP and BNY. So our setup is a positive for Tuesday kickoff. And what I think matters is both the outlook here for earnings as well as the pent-up backlog building in the capital markets. As we look into 2026, we are expecting that estimates will be moving higher throughout the course of the year as the backlog is executed on. I'm talking about M&A. I'm talking about equity capital market activity like IPOs. Yeah. As well as just the global trends that we're already seeing playing out in a way that is positive for loan growth. So I think estimate revisions will be higher.
I am curious, at least on the capital markets side. I mean, we know that certain companies, particularly JP Morgan, has done pretty well in this space. But you've seen companies, particularly like Wells Fargo, trying to make more strides in the capital markets business. Do you see the potential that they, at least in 2026, not necessarily next week, that they will be more aggressive in guiding investors towards returns from that segment of their business?
Well, specifically, I would say that on this earnings season, that as we look to what Wells will be doing in 2026, is going to be a function of their execution. I don't think Charlie Scharf will be looking to overpromise. I feel that there is much more of an outlook here for execution on their goals and their targets, which include getting back some share that they had lost during the period when they had the asset cap on in a variety of businesses. But I don't expect that management is going to tell us exactly what they will do in 26. I think they will point to opportunities for investment spend to deliver in a variety of different areas of the business, not just investment banking.
Well, Wells Fargo is so interesting right now because I feel like they really exemplify what Romain was asking about, the fundamentals versus the valuation. We were just having this conversation with David George over at Baird that the fundamentals look very good for Wells right now. As you say, a lot of that comes down to execution, though. But also, how are you thinking about the valuation of Wells, given that there's a lot of good news in this stock right now?
Right. So I think I would like to start off by talking about the sector overall, that as we're thinking about large cap banks, we're looking for a year of earnings, positive earnings revisions, and multiples staying where they are. I am not calling for multiple expansion for the group, but I do see a pathway for the stocks to perform in line with estimate revisions. That's how I'm thinking about it. And when you look at valuations, I get the point. You look at valuations and you say, wow, these valuations look high relative to history. Remember, we're also dealing with an industry with significantly higher levels of capital than we have seen in the past. So they're less risky. And that should give you some premium multiple. I'm not as worried about the multiples. I think this is more a story of 26 about positive earnings revisions driving the stocks.
And I mean, zooming out, I mean, you think about the positioning of the large banks versus some of the regionals. We talked a little bit about M&A, but where are you feeling like you have the most conviction when it comes just to breaking it down by size buckets?
Well, in my coverage, which is U.S. large cap banks and includes the money centers, B of A, Citi, Goldman, JP Wells, as well as super regional banks like Truist and Wells Fargo, we count as a super regional bank, as well as PNC, USB, names like that, as well as the trust banks, BNY, State Street, where we are skewed for our overweights are on the large cap names, the money centers, where we see the capital markets really driving revenues into 26. And we're overweight on BNY and on State Street on positive operating leverage, in part driven by the benefits of AI rolling through. And these business models, as I'm sure you well know, are very skewed to being beneficiaries of AI. And that's already beginning to come through in the positive operating leverage. And then in the super regional banks we cover, that I cover, we are equal weight, primarily because these are models where we need to see more loan growth acceleration to really move more positively in terms of estimate revision expectations.
All right, Betsy, great to get some time with you ahead of the big dance. That is Betsy Graseck. She is Global Head of Banks and Diversified Finance Research over at Morgan Stanley. Now, coming up, new year, new opportunities. Runa Alam, she is the co-founder and CEO over at Development Partners International. She joins the program next to discuss the investment outlook in Africa. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on these U.S. markets, also taking a look abroad because there was a really interesting report in the Financial Times taking a look at some of the IMF expectations for this year. And African economy is expected to grow by 4.4% this year, actually on pace to potentially outpace Asia.
Yeah, that would be a big deal. And we should point out, a lot of people had that prediction for 2025 as well. Things kind of got a little bit interrupted there, but certainly on the precipice of that. And it raises the question that if you do start to see that material increase in the growth rate, does that make it a more attractive investment opportunity relative to the rest of the world?
Yeah, you have to wonder. We know that, in particular, a lot of U.S. investors woke up to the fact that there's a whole world out there in 2025. There was quite some outperformance, and it makes sense that you're taking a look at these types of growth rates that maybe the puck is moving a little bit. Yeah,
well, our next guest, she's basically made a career of investing in that space. Runa Alam is the co-founder and CEO over at Development Partners International, and she joins us, I believe, from our London bureau. Runa, great to have you here. I know we talk a lot in the past about some of the investment opportunities on the continent, but there seem to be two big developments over the last few months that seem to be maybe signaling a more bullish environment. One, what Katie just mentioned here with the idea of total growth rate for the continent, potentially outpacing Asia. But also some interesting stats that we got a few months ago out of the African Finance Corporation that talked about something more than $1 trillion in effective dry powder sitting on the sidelines that investors are looking to deploy. And I'm curious as to whether you are in that category of folks with that, sitting on that type of dry powder.
No, absolutely I am, Romaine. What I will say is that I've been investing in Africa for about 26 years, and there seem to be about 15 to 18-year cycles. So when the dollar goes up, EM currencies come down and African currencies have come down. So we've talked a number of years of macro issues in Africa, inflation, devaluations, and general malaise. Last year, all that changed. So we're talking about 54 countries, and they're different. But if you look at inflation, 5 countries have lower than 4% inflation. And generally, even in the countries that were high inflation, they've come down. We talked last year, Egypt had 36% inflation. It's down to 12.5. Devaluations have turned into appreciation. Egypt currency grew 7% against the dollar. There are 7 or 8 countries that are more than 10% against the dollar. As a result, also, you talked about GDP growth. Yes, last year, Africa was supposed to be higher than Asia. It's not much difference, 4.1 versus 4.4. But this year, that's supposed to flip. So you've got GDP growth and better macro.
Yeah.
And the fact is, the dollar going down against African currencies makes dollar investments more profitable. And so for us, that is a great opportunity to invest.
Yeah. Well, I have to ask you on that last point on the dollar. I mean, one reason why we saw some relative outperformance in the broader EM space, including in some of those African nations, was because of the weakness in the dollar last year, as well as the fact that most central banks, other than the United States, were aggressively cutting rates. And I am curious, there's the expectation that that dollar weakness will reverse this year, and there's expectations that we could get multiple rate cuts out of the U.S. this year. Does that complicate the investment picture for you?
Well, I started talking about the longer-term trends. If you look over the last 70 years, the dollar goes up in a cycle of 15 to 18 years, and EM goes down. We actually hit the end of that cycle, and the dollar, with ups and downs, generally is expected to go down, according to some economists. So over the next 15-year cycle, we expect the EM currencies, Africa currencies, to stay stable or actually appreciate. What do I think in terms of investment if the dollar changes this next year? The fundamentals in the African countries aren't changing. So I talked about inflation, GDP growth, and there are lots of other, more micro factors that lead to better investment climate. And one of those is that in some of the largest stock markets in Africa, and we're talking about Morocco, Algeria, Kenya, South Africa, 50% growth versus 20% in the NASDAQ and 16% in the S&P. So that means we've been able to IPO. In late last year, we had a 5x IPO in dollars in the Johannesburg Stock Exchange.
Right.
Just late the year before, we had an IPO in Morocco that was 37 times oversubscribed and will end up being about a 3x. So those fundamentals are still there now.
And it's interesting to hear your point on IPOs. I mean, you think about what's going on in the U.S. IPO market. You're seeing a lot of crypto names came through in 2025, but also a lot of AI-related names. When it comes to, these African economies, what types of companies are you seeing potentially tap the public markets here?
So it's interesting. The IPO for us in Morocco was an agribusiness company, but the IPO in South Africa is a fintech. So it is a tech company, and we're going to see more and more IPOs in that sector. If you started off, because we're also in venture capital, digitalization is obviously a big thing, and AI is now coming in. This is the first year it's coming in. In our private equity bucket, there's also digitalization across all the buckets, whether it's a specialty chemicals company that has apps and all the revenues migrate on the app and, it's more efficient, increased EBITDA, or whether it's a straight-on microcredit company that's turned into a fintech and is using digitalization. So on the stock markets, you will see some IPOs, more on digitalization. In the venture capital side, AI, that will come in Africa, but with a little bit of a lag.
And Runa, you made the interesting point that, you think about the direction of the dollar, the trajectory of the dollar. It's not necessarily going to change the fundamentals of some of the companies that we're talking about here. But talk to us about tariffs. We're awaiting a big tariff decision by the Supreme Court, potentially coming tomorrow, on the legality of some of President Trump's tariffs. But how has that sort of factored into the picture of investing in Africa?
So this is a very little known fact. It hasn't. And the reason is about 4% of the trade, of the exports in Africa is with the U.S. It was very different 20 years ago, but the trade with the U.S. has declined. The EU is the biggest trade partner, and then China after that. So the tariffs have made very little difference. There's a tiny country, Lesotho, unfortunately, made a big difference there. For the rest of Africa, not much of a difference. And when you see even individual companies, the citrus industry, citrus companies in South Africa couldn't export to the U.S. They pivoted immediately, their BRICS country, and exported to China. So it's made very, very little difference.
All right, Runa, I have to leave it there. Always great to catch up with you. Great insights, great research. Runa Alam is the co-founder and CEO of Development Partners International. When we come back, we're going to continue to focus on U.S. policy and some of the mixed signals coming out of the White House. President Trump and, well, his view on what U.S. defense contractors should be doing. That conversation is part of our Stock of the Hour right here on Bloomberg.
Well, our stocks of the hour are the defense contractors. The group broadly hired today. That's after a series of social media posts from President Trump yesterday demanding a $500 billion boost to annual defense spending. But that was after he threatened some of the names poised to benefit the most. Joining us live to unpack the moves is Bloomberg TV markets correspondent Norah Mulinda. So, Norah, walk us through this because, boy, some whiplash we've seen in these shares.
Well, we're certainly seeing some whipsawing here. And of course, a lot of questions still remain as we're chatting with analysts and trying to figure out what this really means for the broader sector. A lot of things still remain up in the air. I mean, will spending be passed by Congress? That, of course, is a major thing that we need to know about. But also, what are the exact conditions when you think about buybacks? I mean, also, I was looking at Seaport Research. They have a lot of commentary out on this. They're saying that this could be potentially, quote unquote, devastating to valuation for this company. But they also note the fact that they don't believe that this necessarily, in terms of the order to limit capital buybacks, that deployment will actually see, quote unquote, the light of day. So interesting as we're kind of getting diverse perspectives from people on the street when you're really seeing this balance between, of course, we're getting some capital, we're getting more spending in terms of military spending, but additionally, you know, a bit of crackdown and scrutiny, if you think about it, for these companies.
And it's kind of interesting, at least based on the Trump administration's argument, they think this scrutiny is warranted given that these businesses are effectively run by taxpayer money. And the idea is that they feel like they should have more control over it. But at the same time, he's saying we want to limit what you do here. But then he makes this post on Truth Social saying he wants to basically increase the defense budget by like 50%. And I know that's sort of pie in the sky wish list. But even if you get a chunk of that increase, does that become a net benefit for the bottom line for these companies?
Well, it's interesting because we are also looking at some stuff that came out of Jefferies. They talked about potential share downside when we're thinking about General Dynamics and Northrop. But then on the other end, they're also talking about potential EPS upside when you think about the boost that they will get from spending and that potentially being strong. So we're talking about double digits there. That's what they're laying out in terms of the estimates. But we still have to get a lot of data in from various places to see what exactly this will mean in terms of implications if it does potentially go through Congress.
And of course, all of this is in the context of it is a midterm election year. We know that campaigning is starting early. So what could be the potential political strategy behind some of the proposals that we saw yesterday?
I mean, as I'm chatting to sources, it sounds as though this could potentially be a way to show that President Donald Trump is tough on corporations and that potentially speaking to voters, but additionally also backing a stronger military. So it kind of playing the best of both worlds in this sense, and that could potentially be what he's thinking about in terms of strategy. But of course, we don't really know.
Well, we don't really know. But it does get to this idea, though, too. I mean, we talk about the focus by investors, and largely because of the focus by the Trump administration on the defense sector broadly, not just the big contractors, but obviously a lot of these defense tech companies, some of which are still private here. There is a potential for some regress to flow to these companies, just a matter of when and where.
Absolutely. Yeah. And it's interesting when we think about the context here about this particular situation and the fact that a lot of the big defense contractors are the ones that would be most exposed to the situation because they rely on the Pentagon. Whereas some of the smaller companies, I'm hearing from some of my sources, they may be able to, stay away from some of the exposure and the backlash from this. But we're going to have to see how this all trickles out, really, Romaine.
All right, Norah, great context, great reporting as always. That is Bloomberg TV markets correspondent Norah Mulinda. I do briefly want to bring our attention to some reporting coming out of the FT that Merck reportedly in talks to buy cancer drug maker Revolution Medicines. If that sounds familiar, Romain,
yeah, it does.
It's because there were reports earlier in the week that AbbVie was in talks to buy this company, which the company then denied.
Yeah, absolutely. Merck shares spiking here, up about 4% at one point now, pairing some of those gains here. We'll try to get some more details on that. And when we come back, we continue to count you down to the closing bells and kind of round out here the day to get a better sense here, not only of the market moves today here, but whether there is real strong bullish sentiment going forward. Berkeley Belknap, head of U.S. portfolio management at Franklin Templeton Investment Solutions. Dramatic pause, joins us next.
Companies did build up inventory into tariffs, so there is some risk that we do see more of the impacts start to show up, this earnings season as companies moved through that inventory that they had built up prior to tariffs. But corporates have been very resilient and they've been able to maintain, pretty healthy margins even amidst some of these pressures.
Jill Carey Hall over at Bank of America Merrill Lynch kicking off the show just about 50 minutes ago, and kind of fitting that we spent a lot of time talking this morning, about an hour ago, about what's going on in the small and mid-cap space, because that is the big outperformer here, at least when it comes to the broader market.
Absolutely. Talk about a rotation trade. If you take a look at where those numbers stand right now, the S&P 500 lower, the NASDAQ 100 lower by about 0.6%, and then the small cap Russell 2000 index extending its gain here, higher by about 1%. This has been outperforming big tech in a big way year to date, and you can see that today really exemplifies that. And all the while, you have bonds selling off a little bit, not really providing cushion to what you're seeing in the large caps right now.
Yeah, and I think a lot of people are just sort of looking at valuations and saying, look, when you look at the large cap space, you have very stretched valuations by some metrics. When you look at the small and mid cap space, maybe things a little bit more in line. But of course, when it comes to small and mid caps, it's really about economic conditions.
Absolutely. It might also be about positioning as well, because you have to imagine those large caps fully invested. I don't know if you can say the same about some of those smaller companies.
Absolutely. Industrials, energy, financials in that small cap space leading the charge, with the Russell up about 1.1%. Joining us now as we head towards those closing bells, Berkeley Belknap, head of U.S. portfolio management for Franklin Templeton Investment Solutions. And Berkeley, I do want to start off in the small cap space here, because we started off the show talking about this idea of the potential returns there. The idea that some of the performance that we saw last year seemed to be driven much more by multiple expansion. But at least our own internal analysts here at Bloomberg Intelligence, they're expecting a significant earnings rebound out of small cap stocks. I think for the Russell, they're seeing something like 45% growth this year, which would be at least 3 times what we're going to get potentially out of the S&P 500. Does that sound about right to you?
Yes, it does. And thank you so much for having me today. We are expecting to see very strong earnings growth from small caps this year. But I think one really important caveat is to think about where we've come from. And so we've seen extremely steady growth in large caps over the last few years. And so the base is much higher. We aren't expecting any kind of comparative earnings growth in large caps, but the base from which small caps are coming from was really very, very weak in recent years.
Is there a sense, when it comes to people sort of making bets in that small and mid-cap space on some of those stocks there, how much of that is going to be much more directly tied to economic conditions and, for that matter, rate cuts that are tied to those conditions?
I think that is the key, right? If we have rate cuts, that's a huge benefit for small cap companies, especially the non-earners who are dependent on debt. And we're talking about, looking at an index, the Russell 2000, that has about a third of the companies are non-earners. So they're highly reliant on debt. So interest rate sensitive, way more so than large cap space.
And I also want to talk about a sector level as well, because you take a look at the performance today, and this is just one day, but the mighty outperformer is energy as a sector, higher by about 3.2% right now. There's been a lot of conversation about, what the base case on energy is, especially when you factor in the Venezuela news that we got earlier this week over the weekend and the potential supply dynamics that could introduce. How are you feeling about, some of those cross currents?
There's a lot of news right now, especially from the administration, and it's really hard to parse through that and think about longer term implications. You see a lot of short term volatility in energy companies and defense companies today with all of this news. It's very hard to bring in that kind of news and geopolitical activity into how you're looking at valuations. And so we really try to stick to our tenets of looking at growth and inflation and focusing on interest rates in the direction of where we think those are going. And so trying to avoid sort of the short-term noise there and focus more on the fundamentals of growth in the economy, interest rates, and where we think inflation is going over the course of 2026.
Well, let's bring this conversation global as well, because when you focus on those fundamentals, you think about the direction of interest rates and inflation. Where does that leave you on a global scale when you think about the U.S. In comparison to some of these other markets?
So last year was really surprising, right, for many U.S. investors, seeing the international markets outperform the U.S. for the first time in a while, and emerging markets being the strongest performer. We continue to see the dynamics in emerging markets to look really good, with inflation under control and growth numbers looking very solid. I think there's some question marks when it comes to Europe or the sort of IFA index, where you have a lot of the growth that we saw last year was multiple expansion. And so we aren't quite as positive on that region as we are on emerging markets or the US, where multiples are high, but where we've seen really strong earnings growth. So I think the unique thing about this year is we feel pretty positive about all of global equities.
Yeah.
Whole world actually looks like it's having strong growth, manageable inflation, and so generally pretty positive across equities across the world.
I am curious, at least let's go back to the large cap, and mainly the mega caps, and primarily big tech and that AI trade. I am curious as to where you see that right now. And I bring that up primarily because we did get some data this morning on U.S. labor market productivity and the idea that we've seen a significant acceleration there. And while no one can make a direct connection to artificial intelligence, there does seem to be some speculation that we might finally be starting to see some sort of productivity return on a lot of the AI embrace, if you will.
Yes, and so obviously we've seen some rotation and some more breadth in the markets, and those Mag 7 stocks haven't been shining as brightly over the last few months. But I think you really hit an important point, that if we start to see the return on the investment in AI, and if that starts manifesting in margins, not just in big tech, but across multiple industries, that could really keep this investor enthusiasm going, and we could continue to see a lot of momentum in the markets. And, that wouldn't just be in those large cap technology companies, but really across a number of industries.
All right, Berkeley, I have to leave it there. Always great to talk to you. Berkeley Belknap, head of U.S. Portfolio Management for Franklin Templeton Investment Solutions, counting us down to the closing bells here on this Thursday afternoon. Katie Greifeld, a market bifurcated once again with the S&P basically unchanged on the day. More activity in the Russell and the Dow transports.
Yeah, really interesting to see this coming on the back of pretty hefty volume, but you think about that 30-day comparison, maybe those are some easy comps there, but it's going to be interesting to see whether or not this rotation has legs, whether there is that conviction in small caps, because certainly we've been here before. Yeah,
and a good reminder, too, that we're actually going to finally get a key piece of economic data tomorrow with that monthly jobs report, which could maybe shape perceptions here about what comes next, economically speaking. All right, we got to break down everything that happened today, not only going on in the markets, but in geopolitics as well. A full breakdown with our global simulcast that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell. It's a global simulcast. It started. There's Carol Massar. There's Tim Stanovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. A bifurcated day, Carol Massar, in the market. The S&P flat on the day. The NASDAQ in the red, yet still seeing some meaningful outperformance from the small and mid-cap stocks.
Yeah, I love that you went there. And we keep talking about, the S&P 500 overall, little changed here, barely on a percentage basis. But yet you dig inside the index and you've got most of the names there, more than 350, that are actually gaining ground. So you've got to kind of dig deeper to kind of get to the individual stories and stock trends in today's trade.
I spotted a nice little technical that kind of speaks to the outperformance of the Russell 2000. It's beaten the NASDAQ 100 by about 4 percentage points in the first 5 sessions of this year. It's the second best outperformance to start a year on record.
Yeah, it's pretty staggering. I will say we were having a really interesting conversation with Jill Carey Hall over at Bank of America, who covers small caps specifically. Obviously, she is psyched right now. She likes the little guys, but not the micro caps, not the ultimate small companies out there. So you still have to be careful.
And we should point out, we talk about this setup that we had to start the year. It's still a pretty decent setup, and that Russell stat that you cited, Tim, is really important. But let's not forget, we get a big economic data point tomorrow with that jobs report. We're going to finally get back on the track with that CPI reports. And we have earnings season kicking off, at least for the big banks and some of the bigger companies next week as well. All right, as for today here, you see the numbers on your screen with the Dow Jones Industrial Average adding about 280 points here on the day. That's going to be good enough, up for about 0.5% on the day. The S&P, we'll just call it unchanged, still holding right around that 69.21 level, while the NASDAQ Composite and the NASDAQ 100 dipping by about 4 to 0.5%. And your outperformance, Dow Transports and both the Russell 2000, each up 1.1%.
All right, folks, and back to the S&P 500 I go. As I mentioned earlier, 356 names actually gaining ground in the S&P 500 today, 147, Katie, to the downside.
I am so excited to talk about the circle today because it is absolutely fascinating. You see technology there down by 1.5%. And you take a look at what actually is doing well today, what is lighting up the screen, energy, higher by more than 3% today. Consumer staples also higher by more than 2%. Consumer discretionary higher by 1.7% as well. So there is a lot of movement to the upside, a lot of big gainers today, Carol, but certainly tech taking a bite out of the index.
All right, guys, so let's go to some of the individual gainers, if I may, in today's session. I'm going to look, first of all, at an index, and that is the home building index. That group up more than 4% in today's session. Keep in mind, soaring today after selling off yesterday afternoon when President Trump talked about banning institutional investors from buying single-family homes. So we saw, I think, almost all names. Let me just check on my Bloomberg. All names in this index. Yep, there are 18 of them. All of them are higher in today's session. So it's kind of, we try to make sense out of what the president says, and sometimes we got to see if there's any kind of real policy changes or something that ultimately comes out of it. So housing roaring back today. Defense names also coming back. Take a look at Lockheed Martin, up more than 4% in today's session. General Dynamics, a gain of 1.7%. Northrop Grumman, a gain of about 2.4%. Names again in that group sold off yesterday when the president targeted the group by warning contractors that none of them should pay dividends, none of them should buy back their own shares, or pay executives in excess of $5 million until they speed up production and maintenance of their products. And then shortly after regular trading closed yesterday, we had major defense stocks coming back after we saw the president talking about the military budget should be now $1.5 trillion, a 50% surge for fiscal year 2027. That is a big bump to the upside. And I just want to mention Alphabet, because it did take over, or overtook, I should say, Apple intraday to become the second most valuable company by market cap. So we've just seen Google on a tear. I mean, this is the first time Alphabet has been larger than Apple since 2019. And keep in mind that I think Alphabet was the best performer among the Mag 7 in 2025. And I'm just going to take a look. Alphabet's market cap finishing the day at where?
3.93 billion, Carol Master.
Okay.
How do you do that, Romaine?
You're just checking, right?
3.93 trillion.
You want to make sure I got this right.
Yeah, and Apple's like 3.8 now.
Thank you for doing that.
Sure thing. Tim,
I appreciate
pick up here because you had to help Carol here.
Yeah. Okay, well, let's start with NVIDIA because
it's a tough crowd.
It was kind of Alphabet was kind of a standout when it came to in the Mag 7. We're seeing this rotation out of big tech. NVIDIA down 2.2% today. Broadcom, Microsoft, Apple, Micron, Meta Platforms all dragging the market lower. NVIDIA's down about 11% from those October highs. There was that Bloomberg exclusive this morning that China does plan to approve some imports of NVIDIA's H200 chips as soon as this quarter for select commercial use. Also watching in the S&P 500, memory chip makers took a bit of a dive today. SanDisk, Western Digital, Seagate all falling today. SanDisk down more than 5%, Western Digital down 6%, Seagate down more than 7%. These were some of the best performing stocks in the S&P 500 last year. SanDisk was up 560% from its February debut last year. Western Digital up last year, 284%. Seagate up 225%.
What's driving this, Tim?
Because
I kept looking around between that, all the software companies, the cybersecurity companies, they're all down today, but there's no news.
I know. I was trying to figure it out too. I got in touch with Bill Maloney, who's our
I like that guy.
We love Bill.
Yeah, the
he said
macro squad.
After the performance last year, they're just taking a little bit of a breather.
Okay,
that's the technical analysis, and I'm sticking to it.
A breather.
Yeah. Finally, let's look at ADRs of Rio Tinto today, taking a bit of a hit. Glencore ADRs rose as much as 7.4%. Rio Tinto closed down 0.8% before they fell as much as 3.9%. This after the FT reported that the miners have restarted talks over a potential merger, citing unidentified people familiar with the matter.
And we should point out that as we're speaking right now, Rio Tinto now out with a statement confirming that they have been engaging in talks with Glencore. I just real quickly want to bring your attention to General Motors. You have a redhead crossing the Bloomberg terminal right now. Those plans to scale back their EV strategy, they're expecting to book a charge of about $6 billion for the fourth quarter related to that. And also, I think this is on top of that, there'll be a $1.1 billion charge related to non-EV related business. So in total, the company says expect about $7.6 billion in charges for the fourth quarter period here. That does seem pretty significant. We have to go back and check to see what they said when they first sort of unveiled this new strategy. I feel like we were in the $4 billion range here, but they report in about 3 weeks' time here.
So the total write-down from GM's huge bet on battery electric cars to $7.6 billion following smaller charges revealed back in October. GM will recognize the latest EV charge in a separate $1.1 billion write-down of largely related to the restructuring of its China business. Just reading from David Welch's reporting, this just crossing the Bloomberg terminal.
Which kind of makes, sense that, some of this has been already fed to investors. I'm looking at the stock just down about 0.4%, down 0.2% here in the aftermarket. So we know the EV story certainly for the American automobile companies. And so this kind of is just a continuation of the drawback, certainly here in the U.S. market.
Well, you think about Ford back in December saying that it would take a $19.5 billion charge when it comes to scaling back their own EV business. Maybe that sort of softens the blow of what you're seeing when it comes to GM's own plans. But this seems to be a theme with our big automakers here, just scaling back when it comes to EVs.
Well, and it's interesting, too. There were a bunch of stories, including from Bloomberg, Financial Times, New York Times, just a few days ago, kind of talking about how bad, or I should say how much of a slowdown that we saw in the growth in EV sales. You mentioned that $19 billion. We had Jim Farley on around the time that, that they were talking about that. Now you have GM, and it really is raising a lot of questions for whether all these automakers and that big push that they had made into pure play EVs might have been a misstep.
Well, so I think it's fair to say, as of now, it was a misstep. The goal that Mary Barra had was selling 1 million plug-in cars by the year 2025. It sold about 170,000 EVs last year. It's cutting production and workers. It's already placed 5,500 workers on at least temporary furlough. I think that, as we heard from Ford, EREVs seem to be at least the future, or maybe the bridge to full EVs, but and hybrids. But Americans don't seem ready to fully embrace EVs.
That's the thing. When we spoke to Jim Farley, he was pretty frank that they're listening to the market. They're listening to consumers. And exactly to your point, Tim, it seems like the consumer just isn't ready to go all electric. I will point to some comments from GM CEO Mary Barra. You think about the goal that they set for the company to go all electric by 2035. It's hard to say where this nation and where the driver will be in 9 years' time.
I think it's also interesting. It comes on a day when Piper was out with an upgrade on Ford, GM, and Stellantis, specifically saying they upgraded GM shares to overweight from neutral and says the company has too much earnings power and buyback capacity to ignore, and also cited minimal China risk and a less punitive EPA. Consensus looks beatable. So it's interesting. I don't know. We'll see.
And I just want to point out the reporting by David Welch. He does point out this idea that the company hasn't abandoned the EV strategy. It's more of a little bit of a pause or a slight pullback here. And then he does say in his reporting that the company is working to actually lower the cost of production on those models and is looking into new, quote, battery chemistry and designs that will help reduce those costs that it pays and then, of course, in theory, would reduce the cost to the consumer to bring those cars more in line with the cost of a gas-powered vehicle.
And let's not forget, it's a global auto market, right? And so we certainly see what's happening in China and in India and other places around the world. All right, guys, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romain continuing there, of course, on the close there on Bloomberg TV. Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We will see you again, same time, same place tomorrow.
Coming up here on the close, when we come back after the break, a full focus here on the U.S. economy and a major jobs report that is scheduled to hit the tape tomorrow morning. Raghuram Rajan, professor of finance at the University of Chicago's Booth School and former RBI governor, joins us after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. An interesting day in financial markets today. With regards to equities, kind of a bifurcated market here. Take a look at board behind me here. You see the S&P 500 basically in a holding pattern, unchanged here on the day. But then you look at the big bump that we saw today in the Russell 2000, up 1%. Meaningful outperformance for the fourth time in the past 5 sessions. And that's been a big theme over the last few days. The idea that some of all the valuation expansion that we saw in large caps, now that might actually benefit small caps as investors start to look for something maybe a little bit cheaper relatively speaking. That bifurcation can also be seen in the two sectors here. You saw a big rally today in the oil and gas sector and a big drop today in the tech sector. Not only a 1.5% drop on the tech index overall, but chip stocks, the Philadelphia Semiconductor Index, also following lower as well.
Let's talk about a big reason why, and that's behind me in the form of NVIDIA. Shares falling about 2%, which isn't the end of the world, but this is a ginormous company, and certainly that was weighing across the indexes. I wanted to highlight Lockheed Martin as well. We were talking about this earlier, the whipsaw that you've seen in defense stocks. Lockheed Martin down mightily yesterday, up about 4% today. And then you have Ford up nearly 5% in today's session. It got an upgrade from Piper Sandler. You can see that that benefited Ford to the tune of about 4.8%. But let's get to our top story this hour, and that is the next big test for markets. Traders awaiting a Supreme Court ruling on the legality of President Trump's sweeping tariffs. Now, more than 1,000 companies, from Costco to Goodyear Tire, jumping into the legal fight for refunds. Tomorrow at 10 a.m. Eastern, the Supreme Court will release opinions for the first time this year. It's not clear if that will include a decision on tariffs, Romain, but that is the speculation.
A lot of people are looking ahead to that and the potential economic implications. Raghuram Rajan joins us right now, former IMF economist, now a professor of finance at the University of Chicago's Booth School, also, of course, the former governor over at the Reserve Bank of India. And I do want to start off with the potential tariff decision by the Supreme Court and put it in the context of 2025, because we did see, I think, somewhat surprising growth globally. And that seemed to be tied to the idea that the tariff impact was less than what a lot of people had anticipated. Does a ruling against Trump's use of these tariffs maybe actually provide additional boosts to economic activity?
It could well provide additional boost. Now, remember that what happened since Liberation Day in April 2025 is first, the actual negotiated tariffs came in much lower than were initially announced. Second, the implementation of the tariffs, when they actually hit, was much more moderate than initially felt. And finally, I think there was a lot of transshipment also. I mean, China enjoyed one of its biggest net surpluses on trade last year. But, with all the tariffs that were imposed, it didn't export directly to the U.S. as much, but it sent it through other routes. So essentially, the system has adapted to the tariffs. Now, of course, the big question is, does the Supreme Court declare a large portion of those tariffs illegal because they were set under IEEPA, and the Supreme Court believes that the administration doesn't have the authority to do it under that act? If that is the case, there are two questions that arise. One, when will the tariffs be reset under different acts? And the administration has that capability. The question is when, how quickly, and does the administration even postpone implementing those tariffs because of concerns about affordability and so on. People are seeing some of the impact of higher prices in their daily budgets. The second question is, do establishments get a refund for the tariffs they've already paid, which will be a kind of fiscal stimulus? So both in terms of perhaps the expected tariffs and the duration of when they will be implemented may be a little lower than currently underway. And second, that there will be some refunds, which will be a kind of fiscal stimulus. Both these will be somewhat positive for growth. The negative, of course, is any uncertainty this creates about when, where, and to whom.
Yeah, and we've spoken with some sellers and wholesalers to say that the uncertainty part is more their concern rather than the actual dollar value or level of those tariffs. I am curious, though, about where you see the state of the global economy right now. I mean, here in the U.S., we got a couple data points today that seem to suggest the labor market is okay. Productivity is accelerating for a variety of reasons. Are you relatively optimistic for economic growth here in the U.S. and abroad?
Well, one has to be optimistic, right? Given what was thrown against the global economy policy-wise last year, the fact that the last 2 quarters have been pretty spectacular in the United States, but also very good in Europe. And even China is saying, despite all the deep problems in its economy, it's going to hit that 5%. What that means is a little unclear. But, all said and done, the economy has done pretty well, given the kind of policy concerns that were there through the whole of last year. That means we have good momentum coming into this year. First, we are going to see more tax cuts coming from the big, beautiful bill in the early part of the year. You're going to see, individuals have lower withholdings. You're going to see some refunds coming in from the tax cuts hitting into last year's income. And then you're going to have corporations having lower taxes also. The net stimulus is going to be pretty substantial. Add to that the fact that the Fed has been cutting 175 basis points since September 2024.
Right.
Add to that the possibility that the tremendous investment that's going on in AI continues and is a boost to overall growth. And finally, the fact that the stock market is still holding up is a boost to upper middle class, propensities to spend.
Right.
So all this is good news. The weakness, of course, is the labor market so far. Maybe we get better news tomorrow on that. But it's hard to imagine that corporations with all this, growth momentum will not shift around and move from the no hiring, no firing equilibrium to actually maybe hiring a little more.
Well, tomorrow's jobs report, certainly exciting since it will actually be on time. We're finally working through some of the shutdown delays here. But you think about how the Fed might handle that, of course. And you think about this conversation in the context of Fed independence, because taking a look specifically at the U.S. economy wouldn't exactly argue for the 150 basis points of cuts that Stephen Myron in particular has advocated for. So as we get to May, when we're going to see that Fed leadership turn over, how are you thinking about the question of Fed independence?
I think it's a matter of what the committee, the FOMC as a whole decides, right? And yes, there will be one or two, places that will turn over by May, but much of the committee remains the same. I think the Fed has been somewhat dovish given the data it has had so far. And, I have no doubt that many members of the FOMC will resist a 150 basis point, cut, given if the data continues and even strengthens. But there is still, some possibility of one cut over the year. I don't think you will see a dramatic shift in the Fed's behavior even after May, even after a new chair takes over. The new chair has to persuade the rest of the committee, and many members of the committee have expressed some concern about whether enough has been done and whether they're going too far in cutting more. So my guess is the Fed is about balanced at this current level, maybe a cut more. It certainly is the case that it's going to be hard to see the Fed turn hawkish. And, it may well, given the growth projections that, are in place, it may well need to be a little more hawkish to bring inflation down. Of course, productivity is helping because that allows for growth without inflation.
Right.
But if productivity falters, the Fed may have to, in fact, raise interest rates at some point.
All right. Unfortunately, we are up against the clock. Have to leave it there. That is Raghuram Rajan. He is professor of finance over at the University of Chicago's Booth School and former governor of the Reserve Bank of India. This is Bloomberg.
Some breaking news here. This involving Intel. We're now learning from President Trump here that he actually had a meeting with Intel CEO just some times ago. Trump posting on Truth Social saying that, quote, the U.S. government is proud to be a shareholder of Intel. No other details other than that they met and that Trump is proud. The shares getting a pop of about 2% in the after-hours trade.
Meanwhile, we want to switch gears here because the Senate taking rare action to rein in President Trump, advancing legislation to block further military action against Venezuela. Trump striking back, saying Republicans should be, quote, ashamed of the senators who broke rank. Our next guest is a leading authority on global trade in Latin America as the author of The Globalization Myth, Why Regions Matter. I'm pleased to say that Shannon O'Neill, she is CFR Senior Vice President and Director of Study, joins us now. So Shannon, in the context of your book, you think about how the Trump administration has framed its action in Venezuela basically as a reinterpretation of the Monroe Doctrine, which the U.S. declared the Western Hemisphere off limits. Would love to hear your reaction.
Well, it does seem like we're going back a century and we're really back to gunboat diplomacy because we have seen operations in Venezuela, bringing the Venezuelan president, Nicolas Maduro, out of the country and to New York City here for trial. And so this really is a return to a much more coercive and muscular type of foreign policy from the United States that we haven't seen almost since the Monroe Doctrine. It's a big change.
Absolutely. And with that in mind, I mean, I wonder how the leadership of Venezuela evolves. You think about Delcy Rodriguez, now the acting president, but you think about the Trump administration having a heavy presence still in Venezuela. Who is in charge of the country right now?
Well, we've seen a leadership change, as you say, Delcy Rodriguez, who was the vice president, now the president. But we haven't seen a regime change. We still see the same power brokers, at least so far in power. We're not even a week out, so these sorts of coalitions and control of power could, fall apart, could break down. But for the moment, it really is just the change of the person at the top. And the Trump administration so far seems comfortable with that. They're more focused on their demands of getting China and Russia, Iran and Cuba out of Venezuela. They're more focused on stability, a transition, but they're not talking about transition to democracy. They have not brought in the opposition figures. And they're more concerned about oil and having oil come back to Gulf Coast refineries and to the international markets.
I'm curious, though, Shannon, about this idea of kind of the fragmentation of the various regions around the world, the idea that if the U.S. and Trump's mission is to be much more dominant in the Western Hemisphere and not care as much about what's going on elsewhere, I know the U.S. has the military might, certainly, to do that, and the economic might. But what about all the other players in this? Are they just going to go along with this?
This is the big question. What does it mean not just for Venezuela, which is one case, but what does it mean for the rest of the Western Hemisphere? We've also heard the Trump administration interested in Greenland, in Panama, even in Canada and other places. So really dominating this hemisphere. That is the Monroe Doctrine, this idea. But there's also this idea of spheres of influence. This is sort of old political science, international relations theory being brought back that, what's most important is what's geographically very close, not what's so far away. And I think for others who, have ambitions to dominate their own region, whether that's, Europe or Russia tussling over parts of Europe, whether that's China and Asia, this idea that we're coming back to this, or at least it's being put on the table by the United States, may fit with some of their foreign policies, the way they're viewing the world as well.
But I just had to pin on it. And look, you know a lot more about this, but when we talk about the Monroe Doctrine and the idea of having sort of that dominance on a regional basis, this was the 1800s. We weren't necessarily as global of an economy that we are today. So it kind of made sense. Whether you agree with the Monroe Doctrine or not, you can follow the logic a little bit more. I guess I don't understand how in 2026 we're going back to that, or maybe we are?
So this is where it gets very messy. It was messy at the time because you had movement of goods and trade and minerals and the like. And we have that today on steroids. It's not just, critical minerals and energy and the like that's moving, but it's data, it's, artificial intelligence, it's all kinds of supply chains. So how one would actually unravel is really a question. I think that's where things get incredibly messy. And in the end, I think it's very hard for us to go back to a world of spheres of influence. Not if the United States wants to, maintain sort of the economic prosperity. We were just hearing about the growth that's happened. In part, that's because the United States is such a dominant global player in these. That's how you maintain U.S. prosperity and growth.
Mm-hmm. And Shannon, you made the interesting point that this isn't a regime change. And I do wonder, what you make of the administration's ultimate goal here. We know that oil has been a hefty part of the conversation when you think about Venezuela's oil reserves. Is the motivation as simple as that?
I think that's part of it. I think it's also to sort of prove the point that the United States is back and is going to play a very active, forward-leaning role in the region. They chose the one leader that really has no friends in the region. No one was a fan of Nicolas Maduro, and so easy in some ways, at least that side, to remove. But I think, the question here is, now we're in the day after or the few days after. What happens in Venezuela? Do we actually get to a transition to democracy or not? We're not moving there yet. But what happens to other countries, right? There have been threats to other governments if they don't go along with what the United States wants, that they too might be in the line of fire.
Yeah, and we should point out some headlines now with the leaders of Brazil and Colombia basically saying that they want to see some sort of peaceful resolution to this whole situation. Shannon, I have a feeling we're going to talk to you much sooner than we really would have, given how fast this story is moving. Shannon O'Neill, CFR's Senior Vice President and Director of Studies, focusing in on the Latin American region here. And now we have some other interesting headlines coming out on the housing market. This out of President Trump himself, saying that he has instructed Fannie Mae and Freddie Mac to buy $200 billion in mortgage bonds. He said that he has now directed representatives to buy $200 billion in mortgage bonds and says that Fannie and Freddie have the cash. And in Trump's words, those mortgage bond purchases will, quote, drive mortgage rates down.
Really interesting.
Yeah.
I mean, you think about just the fire hose we've gotten from President Trump on Truth Social over the past 24 hours or so. He does say in this Truth Social that he's giving special attention to the housing market at this moment. We certainly know that to be the case when you think about what we were talking about yesterday and what we're going to talk about right now with the proposal to ban institutional investors from buying single-family homes. And then you remember the idea of 50-year mortgage rates. So certainly this is top of mind heading into the midterms. All right, well, let's have that conversation now. We are going to spend the next few minutes really talking about the state of real estate, and particularly in the context of some of the policy proposals that the president has floated out there. Joining us right now is Elizabeth Bell, co-head of real estate at Hamilton Lane. It's a private equity firm that, with a big focus on the real estate sector. Elizabeth, great to have you here, private capital, I should say. Great to have you here on the program. I do want to first start off about your reaction yesterday when you heard this proposal, and it is just that, by President Trump to limit the ability of investors like yourselves to buy into the single-family housing market here in the United States.
Yeah, I think that the headlines from yesterday were definitely eye-catching for us. The big point is that there is an affordability crisis within the housing sector within the U.S., and it's not just a U.S. phenomenon. This is a global phenomenon. The headlines from yesterday were particularly going after a group of investors, institutional investors, call that any investor that owns more than 100 units. That group is very small in the grand scheme of the ownership. They own less than 1% of the total housing stock. And so when you take a step back, the issue related to affordability is not about that 1% group. It's really a scale issue. And how do we solve the supply side? And so for us, we're very focused on making sure that there's new supply coming online, because that's the only way you're going to solve some affordability crisis.
I am curious, though. I mean, at the end of the day, and I don't mean to be pedantic, but it's not your job to solve the affordability crisis. It's your job to find investments and make money for your clients. And so I am curious as to whether these types of proposals would lead you and your team to adjust your investment strategy.
You know, for us, we're very bullish on the residential sector in general. And there's many different ways you can access residential. We are focused on multifamily for rent side. We are looking to develop. We're looking at market rate. We're looking at affordable housing. And we can also look to bring new supply online, get a great return because there's just not enough supply and there's so much demand. So for us, bringing new stock online, whether it's in the equity position, funding a new development, or even on the construction financing side, where there's very tight lending standards today. If we can step in there to get more money into the system to build new homes, that's a win-win. We can achieve great returns as investors and also help address this issue.
Well, Elizabeth, to ask a little bit more directly on that question, you're, feeling good about residential overall, but you think about some of these policy proposals, some of the cross currents here, would that maybe keep you a little bit away from single family homes?
There's many different ways you can play the single-family home sector. I mean, I think where we stand today, there was a headline yesterday. We're not really sure where the outcome will be. I think for us, we really like the idea of building for rent, which is a different type of product that you are building specific housing units for people to rent. And given the fact that, post-GFC, mortgage standards became so much more stringent, it has become a very difficult proposition for many families to own a home. And so they are forced renters. By going into some of these build-to-rent type of investments, you really have a large demand pool that wants access to housing in safe, affordable, desirable neighborhoods. And through this build-to-rent strategy, you can achieve that.
And so I do want to ask a little bit about multifamily homes, because talking about residential overall, clearly, of course, the focus right now is single family homes. But you think about multifamily developments. I'm taking a look at some of your notes. It's an area where you remain bullish. So compare and contrast what you're seeing in multifamily right now versus maybe single family.
Yeah, I think with multifamily, it is a much more established asset class. So from our perspective, investing in this asset class, you're very certain on the exits. It's a very liquid market. And, you can be in much more urban settings where the population is denser. And from a real estate perspective, we like that. We like the population density. We like population coming into locations for job growth, places that are desirable for people to live. So we really like multifamily. I think we also find that there is a place in the market for the single family ownership and rental type of environment. But those tend to be more in the suburbs, and they're, they may be in a plot of land which is all together, or they might be scattered sites. And so the exit on that is not as robust and proven as it has been on the traditional multifamily side. So we lean a little bit more towards traditional multifamily, but we like both sectors.
Before we let you go, Elizabeth, I do want to get your thoughts on what's going on outside of housing, real estate, and particularly when it comes to the data center space. We've heard from so many investors saying that they're looking at data centers and they think the prices are just too high. Maybe they're willing to sort of buy up land and do a lease back or something like that, but they don't want to do a real carry of any real properties in that space longer term. Are you finding similar issues with pricing?
It's interesting. I think a lot of the talk as it relates to data centers is around the hyperscaler market. These are massive facilities, and they're typically rented to a single tenant. And the ones we would go after are, your likely suspects that have high credit quality, tech-oriented companies. There's a whole different level of data center requirements and almost a supply chain, a logistics supply chain to get data from those hyperscalers to the end user. And similar to last mile logistics, we see you've got the hyperscalers on the outer ring road, but then you have to go through co-location facilities, co-location data centers that ultimately end up at hotel carriers, which are usually in urban settings. And so, yes, we like the data center play on the outskirts with these hyperscalers. Development yields have compressed, and I think it is expensive to buy on a stabilized basis. However, there's a profile of capital that fits that very nicely, insurance capital, for example. But we're also now looking at those other two layers that get to closer to the urban core and that are required from a supply chain perspective to get that data from hyperscaler to co-location through their carrier to the end user.
All right, Elizabeth, great to get some time with you. Really appreciate it. That is Elizabeth Bell. She is co-head of real estate at private markets firm Hamilton Lane.
And just some quick breaking news. We want to get back to this conversation on the housing market, but some headlines here on Apple CEO Tim Cook's compensation for the most recent year coming in at $74.3 million. If you're keeping score, it's actually down from $74.6 million the previous year. I think he's going to be okay.
Yeah, a little bit of a pay cut, but I'm not worried there. Meanwhile, let's get back to our conversation on housing, because our next guest runs a long-standing real estate brokerage with a major presence here on the East Coast. Joining us live in studio, I'm pleased to say, is Brown Harris Stevens CEO Bess Freedman. Bess, it's great to see you.
Hey guys,
Hey,
Happy
Bess.
New
How
Year.
you
So
doing?
good to be here with both of you.
Absolutely.
And boy, what a start to the new year.
Feels like an earthquake.
Yeah,
right?
Especially when it comes to the real estate market. So clearly this is a focal point of President Trump, and I have to imagine the Democrats as well, housing affordability. And before we talk too much about the specific proposals that have arisen in the last 24 hours or so, from where you're sitting, what do you think is the key root of the affordability crisis in this nation right now?
You know, I think we have to come up, your guest before was talking about it, we need more supply. And so I think we have to have less restrictive zoning. Things like the City of Yes that Mayor Adams got passed is a great way to start. I think things like rent control is not helpful. A 50-year mortgage is not helpful. I think restricting corporations from buying homes is not going to help. That's 2 or 3% of the housing stock. It's not going to do much. I think we have to really figure out ways to build more homes so people can there's more supply in the market. So supply and demand is the central nervous system of the housing market. And so these little talking points that politicians are selling are not helpful, I don't think.
Well, you have to imagine that the volume will only increase as we get closer and closer to the midterm elections in November. But when it comes to your point that we need more supply in this country, I think a lot of people would agree with you. Talk to us about the demand side, though.
Yeah, I mean, it depends on where you are, right? Because all real estate is so local. We are in New York City, which is a very different market than many parts of the country. So, this market, I mean, the prices have been pretty flat. We had a really good 2025. It was recovering from 2024. It was challenging, but much better. More people got into the market. And rates do play a part, but not as much as the rest of the country, because it's more discretionary, so people pay cash. But when rates come down, you see more buyers get into the market, and you see sellers willing to list their homes because they've got a lock-in rate of 2 or 3%, so they've been holding back. But if it's at 5 or maybe 6, then maybe they'll get into the market. And so that's kind of what we've been seeing.
Do you think we're going to see more inventory in the New York area, at least in the markets that you cover, relative to the last couple of sort of spring selling seasons, if you will?
I think little by little. You're not going to see anything explosive.
Yeah.
I do not see that. I see little trickles of more inventory coming in.
Yeah.
It's slow and steady progress, but it's going to take time. We have a new administration, right? We have a new mayor who's in place, who has all these new plans and policies, and we have to keep the city safe, and studies have shown that freezing the rent, there's decades of evidence that support the fact that that does not help the housing market. In fact, it makes it worse. Obama's chief economist spoke about this in great detail. And so we want to have good policies. Forget if you're a socialist, Democrat, Republican, good policies to help our city.
Do you worry at all? I mean, you deal with a lot of high net worth individuals, and there's been a lot of just anecdotal evidence, no real data saying that, people are going to flee New York because of some of the potential policies that the new mayor might implement. Have you gotten any sense that there would be any sort of real migration by some of those folks out of the city?
There has been a drop of it. Some people have decided that, they may move or they're going to leave. We saw California news today that a lot of people are leaving because of that big tax. But it's still unwritten, and it's hard to say. If safety starts to falter in New York City, you will see people leaving. Affordability, yes, is important, and that's why Mayor Mamdani won. But Mayor Adams won because of safety, and we have to keep that in the forefront of our minds in a city like New York. We need safe streets and safe subways.
Absolutely. And I do want to go back to the point you made that when it comes to, what we're dealing with when it comes to affordability, in your view, a lot of that might be fixed by less restrictive zoning. But talk to us, too, about, the cost of new building right now, the pure material cost and how that is factoring.
Well, see, that's another talking point from sort of the right. This anti-immigration and the tariffs are not helping housing at all, because you have people who are not showing up to do their jobs on construction sites because of fear, right? And then these tariffs, I read a study today that said the average home is now $11,000 more because of these tariffs. So that has actually hurt the supply in housing. So, again, we need good policies. Forget the labels. Labels stink. You know, we need to have people that come in with good ideas so that we can build and get people into homes. We want first-time home buyers to not be 40 years old, which is what they are today. They should be in their 20s, late 20s or early 30s. We got to get back to better with the home buying process.
Do you think, though, that the solution to that will be more at the local level rather than at the federal
100%.
Yeah.
It's always local.
Yeah.
You have to work. It's, you know, Mayor Adams got City of Yes passed because he worked with city council and borough presidents. He had hundreds of meetings, and he started that in 2022. That was no easy feat. And that's going to be his legacy, and people will remember him for that. We have to keep that in mind.
All right, Bess, always a great to have you.
Guys.
Great way to start the year with Bess Freedman. She's Brown Harris Stevens CEO. Katie?
Yeah, let's take a look at some of the movers in the after hours because there's a few of them. We start with GM, of course. We broke the news just about an hour ago or so that they're going to take a charge. Their charges on EVs balloon now to $7.6 billion. That says U.S. demand craters. Also taking a look at Ford moving slightly here. Intel, Trump had a meeting with the CEO, shares up slightly. And then you have a mortgage lender on the board, UWM, currently higher after hours.
In fact, all the mortgage lenders rallying.
Yeah,
Rocket
that's
companies and the home builders, Lennar, Zillow, all up on this latest Truth Social.
Yeah, as we digest sort of the repercussions
I got to get on
there.
Truth Social. What goes on there?
You know, everything just read spikes on the terminal, so it's probably fine. This is The Close on Bloomberg.
All right, let's talk movies. Imax closing out 2025 with a bang, posting the best year in its history, a record $1.3 billion grossed at the global box office. And our next guest says this year could be even better. But there are some issues out there. Netflix appears set to take over Warner Brothers Discovery in a move that raises questions overall about the future of theatrical film releases. Joining us right now is Richard Gelfond. He is the CEO of IMAX. Great to have you here, Rich.
Great to be here, Roman.
Great year all around for IMAX specifically. You had some big releases that helped to sort of lift you up. As you look into 2026, you're already starting off the year with that long-awaited Avatar pick, which is doing well. But you got some other big movies on the slate on the slate coming up this year. Are those movies going to have the same impact on your bottom line as we saw in 2025?
I think they'll have a bigger impact than they did in 2025. So when you look at our biggest movies of 2025, they're not the ones you would think of. So there's Neja 3 coming out of China. There's Demon Slayer coming out of Japan. There's F1, which was the Brad Pitt racing movie. Those are not like when you start a year, oh my God. Yeah. But when you go into 2026 and as you said, Avatar is doing extremely well right now, especially outside the United States. It's really crushing it. And then you've got a new Mandalorian Star Wars movie. You've got Chris Nolan's The Odyssey, which is the first movie ever filmed exclusively with IMAX cameras. Completely. You have Narnia, which we're doing with Netflix, which is being released first in IMAX for a month, and then on Netflix, something that's never been done before, and then Dune 3 at the end of the year, in addition to a lot of things. So when you would sit here today versus a year ago, it looks not much better than it did a year ago.
I know we've talked in the past about the idea of the relationship you have with directors, and particularly those directors like a Nolan who really wants that sort of massive theatrical experience, and they feel they can only get it from a technology like IMAX here. Are you seeing more directors, and more importantly, younger directors actually embrace the format as well?
We are, very much so. So we can either take films that were shot in regular aspect ratios and release them in IMAX, or we could use IMAX cameras. We have a program called a Film for IMAX program. So in 25, we had more of those than we ever had in our history. And we have more in 26 than we had in 25. And a lot of the filmmakers were kind of younger ones doing it with IMAX cameras for the first time. So Ryan Coogler did Sinners with IMAX cameras, and there's much more demand than there was.
Yeah, I mean, that dance scene, which everyone talked about, and then the cameras that he had to use to set that up anyway.
Yeah, there you go.
It was fantastic.
I am curious about what you make about what's going on in your broader industry, though, because IMAX, of course, a clear bright spot when you think about your 2025 numbers, but Variety reporting that you take a look at the domestic box office falling short of a projected $9 billion in 2025. I mean, what do you think is going on with movie theaters overall?
So again, you said it, but I have to say it again. So the movie theater traditional box office has nothing to do with the IMAX box office. So 25 was a record for us, up 13% from the previous record before that. And we're a diversified global platform. So the U.S. is about 1/3 of our box office. As I said, our biggest movies came from overseas. This is a traditionally slower time of year, but it's Chinese New Year. Well, we have a very big platform and good releases coming up in February. So, the movie business is an up and down business. I know, like the TV business, which you guys know something about. But the IMAX business is a different business. We're a platform. Last year, we had a record 130 pieces of content. So we have alternative content like concerts, we have foreign language content, we have sports content, a lot of local language content. So it's just a completely different model. So maybe to circle back to your question, I think maybe North American exhibition has to think about who they are and what they do in a different way and play a more diversified slate, which is what we do.
Mm-hmm. Well, you mentioned, it's an up and down business, and I'd love to situate this conversation in the context of what we're seeing when it comes to the economy. Still stubbornly high inflation. It doesn't seem to be taking a bite out of your numbers, of course, when it comes to IMAX. But you think about past economic cycles that you've lived through, potentially a weakening job market coming up. How does that typically translate into what you see?
So, unfortunately, or fortunately, I've been here over 30 years, so I've been through a number of cycles, and through every recession, we've done better than we did the year before. So we seem pretty recession resistant, and the movie business in general is pretty recession resistant. And again, because we're global, only 1/3 of our revenues are from North America, so you can't just really correlate it to the economic cycle. So, and 25 wasn't exactly a boom year throughout the year, and our business was very strong. So I don't think it really correlates to the economic cycle.
Well, Richard, it's always great to see you. Really appreciate your time. That is IMAX CEO Richard Gelfond. Now, still ahead, what investors need to watch over the next 24 hours. We'll tell you all about it next. This is Bloomberg.
All right, we're keeping an eye here on the after-hours trade. You're seeing mortgage finance companies get a pretty big boost. This on the back of a Truth Social post by President Trump saying that he has ordered Fannie Mae and Freddie Mac to deploy about $200 billion to buy up mortgage bonds. Katie Greifeld.
Yeah, really interesting and trying to sort through some of the implications here. But you take a look at the after-hours move. Lennar higher by nearly 3%. Same story if you take a look at KB Home, Toll Brothers, et cetera. Again, still trying to sort out what this means because, once again, this is a Truth Social post that maybe invites more questions than answers.
Well, we're getting some answers now. Bill Pulte, who leads the agency that oversees Fannie and Freddie, now speaking to Bloomberg and telling Bloomberg that Fannie and Freddie have the cash to buy $200 billion in mortgage bonds. Pulte also says that Trump's mortgage bond order can be executed quickly. So a lot of questions here about, I guess, why they're doing this and the idea, of course, of how fast, if at all, they will implement it.
Yeah, absolutely. It's going to be interesting to see how this story evolves overnight and by the time when we come in at 3 p.m. tomorrow.
I have a feeling there might actually be a whole different set of news by then. It's been fast and furious with the news coming out of Washington as the White House starts off the new year. Katie Greifeld, with a variety of orders. We were talking earlier with Bess Freedman and, of course, Hamilton over at Hamilton Lane, Elizabeth Bell at Hamilton Lane, about that order from yesterday. Yeah. And then we don't even want to get into all the Venezuela stuff and everything else going on there.
Yeah, absolutely. Yeah. But what we do know is that this is an administration that is very focused on housing affordability, in addition to all those geopolitical concerns you mentioned.
There's a lot to parse here, and we should point out that balance of power is coming up at the top of the hour. They're going to have a fuller breakdown right here on Bloomberg.